I joined tech. I've been rattling around the entrepreneurial world since 2001. The first 20 years of my career was with a management consulting firm. And the last 20 years has been in various aspects of these startups. I started out with leading a group within Raytheon, the defense company, to find defense technologies that had commercial applications and they'll create companies outside of Raytheon with other people's money. I did that for a couple of years. We launched 5 companies. We got 2 to liquidity events, which doubled the amount of money they'd put in over the period of time in the first couple of years. And the third one actually grew to be about $800 million company in about 8 years from scratch. So been on that side of it. I've done a lot of investments in startups through Tech Coast Angels when I joined in 2003. I've probably done 60 plus deals at this point. And I took a little journey along the way there from 2007 to 2011, where I co-founded a company and was on the other side of the table raising money. And we were fortunate to have Kleiner Perkins as our lead investor and Google Ventures and a couple other interesting folks in there. So I've been sort of involved in various aspects of this. But as Dan said, when I joined Tech Coast Angels back in 2003, I asked the question that many people ask is just, how are you doing? And the answer came back, we have no idea. And I always thought that was a bad answer because it either meant that you didn't care or it meant that you've done the analysis and it's not a particularly positive story, so you're hiding something. So over the first 10, 12 years of that was the answer. And finally, I just decided, well, let me try to see if I can figure this thing out and do this thing, forensically, what the returns have been. So I started this process, as I said, about 4 or 5 years or so ago, and focused obviously on identifying the outcomes of the companies that we'd invested in, and then figuring out for the ones that were positive, do the forensics to go back to see how much it was valued at the investment and what the size of the checks coming out, and be able to answer the question that way, rather than we had been lost in the details of trying to keep track of every round and the cap tables, and it's very hard to do that. But anyway, so I'm going to show you some of the outcomes of that. But all of this is in the context. We put out, for the last 4 or 5 years, we've put out an annual report which talks about our activity in the previous years. So I've got some slides that just come directly out of that. I won't spend much time on that, but just give you a sense of the scope of what we do. And in that annual report, we always have some charts on trends and deal terms and valuations. And so I'll show you that. I'll show you a little update of what's happened the first half of this year beyond what was in the annual report. And then hopefully spend most of the time talking about the portfolio and the performance and what kind of lessons learned we'd be able to pull from this. And obviously, as we go through this, I'll pause and any questions that you might have. The top line for last year was, it was a very strong year for Tech Coast Angels. As Dan said, we're very similar to Alliance of Angels, both in our maturity and the number of companies we invested in, the number we do each year. So a lot of these things I think will look pretty similar to what you've experienced. We grew our investment last year to 91%, to a record of 19.1 million. Most years were in the 11 to $15 million range. So that was really very different. We have been investing in about 50 to 55 companies the last 3 or 4 years each year. That's a combination of new and existing. But this past year, the amount per company went up, and I'll tell you some of the reasons why that happened. We did grow our membership, which allowed us to deploy additional capital. We were up to 458 at the end of last year. One of the big things that happened last year is we started implementing annual chapter funds. And the San Diego chapter was the one that did this initially, and now the other 2 large networks or chapters, Orange County and Los Angeles, have done that this year. So this year it's bringing $6 million of additional capital to bear against deals this year. That helps us in bringing diversification to members' portfolio, which is very important, because I'll show you some analysis that we've done using Monte Carlo simulations of how important that is to have a diversified portfolio. We also made some changes in our processes. We had done some self-assessment and took to heart some of the criticism that we were taking too long to make decisions. So we now have a process that we promise that we will get a decision on the fund within 30 days. In the past, it could take 3 months or 4 months or even longer. We've realized about 5 or 6 exits a year. We had 5 last year. One of them was a 31x, and one was 19x, and one was 6.5x, and that kind of maintained our overall multiple at 4.8x, which is the multiple that if we've had about 430 companies we've invested in since 1993, about 200 of them have had outcomes. About 80 of those have had some money back, and I think the number is about 60 have had more money in than we got back. And if you'd invested in all 200 of those, the 4.8 is what you would have seen on that first thing. And the IRR is a respectable IRR. We continue to mentor and guide 225 companies, so the majority of the portfolio is still active. We have a few potential ones that will be home runs in there, and I'm sure we will have many failures in there because that's the nature of the beast. So here is the trends over time. As you all know, this is a cyclical business. When the markets go into a funk and valuations collapse, it tends to bring our values or the amount that we invest down, largely because you all know that many of us angels have money in public stock market, and when that suddenly goes and takes a big dive, it becomes scary and we have less cash available and we don't want to sell necessarily. And so it went down in the 2002-3 and the 2008-10, and I expect it will be going down in the next couple of years as we hit that cycle. But we've been on this sustained run since 2011, and most years we're in that range of 12 to 15 or so. The first half of this year, we did 9.7 million. Just for reference, that's a lower rate than last year, but it's more than any of the previous years. When we look at the number of companies that we're investing each year, it's a similar thing. You can see during the cycles, actually, we continue to invest in company, but less money go into the deals during those down cycles. And in the last couple of years, as I said, it's been about 55. We've had 31 so far this year, and 21 of those have been new companies. In terms of industries, it pretty much covers all the industry segments. This is a pie chart showing that. Life sciences is our biggest industry in recent years, followed by software, and then sort of consumer internet tends to be the third, and hardware tends to be the fourth. But anyway, that was the mix. You can compare those two pie charts to show that the size of deals also kind of varies a little bit by different industry slices. This just shows you the trend over time. It jumps up and down, but one of the advantages of having over 100 members, and I think you all appreciate this too, is that you get a chance to have somebody with expertise in almost any industry that tends to walk in the door. So we feel a little bit more confident making investments when there's somebody who has that knowledge. And I'll show you some charts later on to show that the returns tend to be better when an angel group and the angels that are doing the investment have some expertise in the industries. When I tell you some anecdotes about that later on too. These are the companies that we invested in last year. If you look at the little blurbs, it's quite a smorgasbord of different kinds of things. The ones that are in red are the ones that were more than $1 million that we put in. There were 5 that were more than $1 million. 3 of those were new companies and 2 of those were existing companies. I've passed along a copy of these slides if anybody wants it, and it's in the annual report as well. There were actually 6 companies over $1 million, and I stated that. The biggest deal was a company called Buy It Installed, which was $2.7 million. That was a follow-on deal. We had 2 that were over 2 million, and then we had 3 in $1 to $2 million range. These are the ones with follow-on investments. One of those we just had an exit last week, but it was for stock, so we don't count that as an exit. One of the things that was different in recent years is that we implemented this group called Angel Syndication Network. Many of you might be aware of that because A of A does participate in this as one of the members. When I was chairman of Tech Coast Angels a few years ago, I was a strategy consulting over the years, and I took the data point of Angel Capital Association saying that we had $25 billion of angel investment every year. And when I looked at these large angel groups like your group and Tech Coast Angels were on the order of 10 to 15, I said the market leader is 15 divided by 25,000. That's a very, very fragmented market. And usually those things result in some kind of a roll-up for a bunch of reasons. I didn't think a roll-up was going to happen, but I thought there was an opportunity to do a much better job at syndicating deals so we could bring more capital more quickly to deals, make the process less painful for the entrepreneurs, and give our members opportunity to invest in a broader set of deals. So we formed this Angel Syndication Network, and once a month there's a virtual meeting. Any of you can participate in this if you'd like. 3 companies get presented. One of the angel groups on this page will sponsor the deal, it's all done after the due diligence has been done by that sponsoring group, and we make the due diligence available. So it's all a very quick, accelerated kind of a process. I've invested in a couple deals. One of the deals I invested in was one of your deals, AutoNexus, that Dan also had pointed out to me, and that company seems to be doing very well. And I just, Dan, I didn't tell you this, but on Sunday, my granddaughter, 1-year-old granddaughter, had a problem of an ear infection, and my daughter-in-law, who's a pediatric cardiologist, said, "Well, I can't tell whether it's a bacteriological one, a bacterial infection or a viral infection." I said, "Well, I've invested in a company that's actually trying to solve that problem." So I'm looking forward to that getting out into the market. ASN funded 8 companies in 2019, about half of the companies that are presented at ASN. And you can see they've been sponsored by various companies in there. One of the things that was different in this past year was we started to implement these chapter funds. We have always had, as long as I've been in Tech Coast Angels, had a sidecar fund, but it's relatively small in size. And it was there was a group of people making decisions on investment. And in 2019, the San Diego chapter, when they changed some aspects of things, they created a fund. It was a $2.5 million fund, and they tried to encourage all the members to participate. And there's an opportunity to invest up to $500,000 before the first member even writes a check. And that is a thing that's improved, I think, our quality of our deal flow, because to get a quick answer and be able to inspire, 50% of the people to be able to get to that kind of a number, that's pretty exciting. So in this current year, as I said, we've got $6 million that's been collected and is ready to be deployed. We've already deployed a little over 2 million of that. So I think that will keep the numbers up in the current year. You can see on the right, the top 10 deals in San Diego in 2019, all but one of them got investments from either the sidecar fund or the sidecar fund and the ACE fund, which was the fund that had existed before. As you can see, that allows us to improve the amount of capital that we bring to each specific deal. So I think that's a positive development. Been a positive development for us, and I think it's been a positive development for a lot of other chapters of other angel groups out there. One of the things we report, yes.
Before you move on, there were a couple of questions I'd like to get them. One question from Omri is, how many people do you employ to facilitate the group and related funds, and what are they being paid, if you can share
The answer is 3 people. Each of the major chapters has one person who's a full-time person, and I don't remember exactly what they're paid. I think it's something on the order of 80 to 100. I'm not positive on that. I can look that up and get back to you with that, Dan.
Thank you. I know that in terms of the funds, if I remember right, they also get a very small carried interest in the fund. Is that correct?
The way we do our funds is the carried interest goes, well, I think it's maybe done a little bit differently in the San Diego fund, but most of the funds we've done, the carry goes to the members that are participating in the fund. So the actual management of the fund is a volunteer activity that we participate in. And then the carry goes to the members. And one of the things that we've done historically with the ACE funds, for instance, is the carry goes to the members in the fund, but it's only to the members who are still members. So it's actually also an incentive to stay as a member. So when we have an exit, all of the members that are continuing to be in there would participate. So for instance, on one of the ACE funds, it was a 10% carry. We had an 8X exit on one of our deals, but I ended up getting twice that in terms of the carry because people had left at that point in time. So it's a little bit complex, but it's done as a volunteer basis. Was there any other questions before I go on?
There are quite a few, but I know you're going to get to some of them. One is the business segment. There was a question from Mark about what that includes.
Of how we cut our verticals?
Yes.
Yeah, so I'll get to some slides about that. Should I proceed, or any others you want to introduce at this point?
Please proceed.
Okay. So these are just some quick snapshots of the stage of development. The left slide is the mix of companies in terms of numbers of companies, and the right is the mix of dollars. Most of the companies that we invest in these days are actually in revenue. That was not true when I joined back in 2003. Probably only 20% were, or 15 or 20% were in revenue. But most of the companies these days are in revenue, and that's a bit of a change. And most of the companies that are in the R&D slice here tend to be in product development, tend to be in the life sciences. So when you get outside of the life sciences, most of them obviously don't get revenue until they get an FDA approval. So if you think of 38% or 40% in that, most of that product development and R&D slices on these pages are in that vertical. So when you get into the other verticals, usually there's some evidence of customer traction, and it may be very small amounts of revenue, but some amount of revenue. In terms of the stage of the round, we still focus on very early stage deals. Most of it is in the seed category. Some of it is in the Series A. There's a little bit of bridge money that comes into there, but we're starting to see some interest in later stage follow-on rounds. It's potentially very high valuations. That's quite different from what we used to do in the past. And so that's, I think, one of the changes. And some of those actually, where there's evidence of traction, may end up producing a higher return than the early stage ones, which have a much higher failure rate associated with them. So the multiple might be less, but the IRR might actually be more attractive because more of them get to that multiple. In terms of the deal mix, it's still convertible debt and preferred equity. I have a bias against convertible debt, but still a lot of these deals come over as convertible debt deals. We are seeing some safe, but not that many. We get a few of these later stage kinds of deals that are actually in common stock, and we're starting to see a sprinkling of special purpose vehicle kinds of deals. In valuation, it's gotten out of control in valuation, in my opinion. And the valuations are way too high right now. I personally have cut way back on my investments because of that, because I think it's going to be hard to earn the kinds of returns you need to earn in an angel portfolio, given where the valuations are starting out. But in the, if you look at this chart, you can see that the bread and butter of our valuations tended to be in the 1 to 3 and 3 to 6 billion over the years. And that's gone down to a very small portion. Quite a few are now in the 6 to 10, and we're seeing valuations in the 10 to 20 and over 20. If you look at that actually in terms of median, the median's been going up for TCA from about 4.5 million in 2016 to in 2019 up to 9 million. The information that that the PitchBook's published, and in more recent years the Angel Funders reports published, it's happened across all angel groups. The Angel Funder report number was 6 million. We tend to be higher largely because the prices are being driven up primarily by Northern California angels and early stage VCs, but those numbers are going up. And if you look at the percentages on the percentiles, you can see that even at the 20th percentile, it's gotten up pretty high. The 20th percentile in the first half of this year was almost $6 million. So those things have gotten pretty high. And the follow-on rounds too have been going up, but that shows you the range there. If you look at it in terms of the broad perspective, only 15% of our investments in 2019 were valuations below 6, and that compares to 41% in 2018, 43 in 2017, and 61% in 2016. The median valuation, which is that chart I just showed, is going up from 4.5 up to 9. And the long-term sweet spot for angel investing are deals that are valued at 1 to 3 million. And this is 1% of our investment from 18% of our investment in 2016. And it has a real impact on returns. We just had one exit in 2020, which was a 47x, but it started out at 1.8 million. And I just can't see us getting to those high numbers. That'll be important to get to see the overall portfolio return. So before I get into the portfolio, are there any questions on any of that trend information?
Yeah, let me start by saying we will be sharing the slides. What percentage of the chapter funds are coming from large investors like VCs versus individual angels? And this is a question, I think, for the ACE funds.
Yeah, most of the investments tend to be, the vast majority, 80% of the investments of the individual angels are in the $25,000 level. There are a few of our members that might put 100, 150, 200 in deals, but we tend not to have super angels that are putting $1 million into deals. In terms of the sidecar funds, it's a $10,000 minimum investment in the sidecar funds, and the goal is to get as many of the individual members to participate in that. Some people put 10 in, some people put 20, some put 30, some may put 50 or 100 in. But it's largely funded by across a lot of individuals, investors just trying to get portfolio diversification.
Yeah, I know for San Diego's ACE fund that is ACE 21 that's just closing. I think they had like 95% participation from the membership, and they have what, 180 members?
Yeah, so it's, I don't know the specific numbers, but I don't think it's particularly biased by somebody putting in a lot of money. But I actually don't have that data right in front of me, but it's worthwhile looking at it. I know for the Orange County Fund and the LA fund, which were raised, as I think about 4 million went into the San Diego fund and about 1.5 to 2 million in the others. Those were all smaller numbers by individual members. So it's really driven by broad participation. And I'll show you here on the diversification why that's important.
And last question from Chris Phillips: how often do you syndicate with other angel groups and other angel funds?
tend to syndicate. We do more syndication now than we used to do. I don't have the numbers on how much goes into those. It wouldn't be in any of these numbers because this is all the numbers that we put in. So when we have another angel group put money into it, none of that shows up in any of these numbers. This is just the numbers that our angels put in. But my sense is that probably, more than half of the deals have other angel groups that we've either introduced or they've introduced us to them. And I think that's very much a trend that's happening. You mentioned that A of A, the largest you'd done was 5 million. The largest we've done was 6 million. And that was in a deal that we actually weren't the largest angel group in it. Central Texas Angel Group put in 8 million. And across all the angel groups that there's a company called Savara that put in it totaled over 40 million. And basically all of those angel groups got the company to the point became a public company. And so that's something that's different in the angel world today. 10 years ago, I don't think you would have had a single instance of any company that raised, $40 million from angels, never took any VC money and got it to be a public company. That's definitely a trend in the future that's happening, and I think will continue to go into the future. Should I move on?
Yes, please.
Okay. So when I frame the question on portfolio performance, there have been some studies that have been done in the past across all angel groups. Rob Wiltbank, a professor, has done some of these associated with various universities and groups that he was associated with. And they looked at different numbers of deals and different numbers of angels and angel groups in there. So I'll show you some numbers that come out of those. And then I'll show you our numbers and also Central Texas Angel Networks, which is another similarly sized angel group in the US. And they have about 80 deal outcomes and they have about 180 angels. So it's a similar size thing. One of the things that's exciting is Angel Capital Association. Most of you are probably aware, 2 years ago started a data initiative where all of the groups are encouraged to pool their data, and you can then do analysis on not just the data that you have, but the analysis of the data from the other groups. The data is anonymized and protected, and each of the groups that's participating in the data owns the data. We were concerned with Angel Research Institute was selling the data that we were providing, and we thought we really wanted to do a better job at it and control our own destiny. So some of this data you'll see coming from C10 and TCA, but I think it'll get much better because even if you have 80 or 100 outcomes that you're measuring, you still can come to some aberrant conclusions because because of the home run effect, and the big home runs tend to be few and far between. If you look across all of those, tend to be, the ROIs tend to be in about 2.5 times return in terms of the multiple. We've got a little higher in Tech Coast Angels, I think driven because we got lucky. We had 3 big home runs out of our 200 outcomes. And we also did that over a longer period of time. So our IRR is kind of comparable to the other measures there, and tends to be in the 20s somewhere. But they're all pretty similar in that 50 to 70%, got less than their money back, and across all of those data sets, something of 85 to 90% of the returns come from less than 10% of the exits. So this is definitely part of the nature of angel investing. The specific exits we had in 2019, we had one which was a secondary offering, which was a 2014 estimate. That was our highest multiple of the year, 31 times return. We had 3 that were acquisitions for cash. Parcel Pending was the biggest of those, which was a 19x return. I was in that deal. That the only thing I can say that I wasn't pleased of it, the outcome was 4.5 years after we made the investment, so I had to pay a lot of taxes on that. But as you all know, we can't determine when the outcome is going to happen. Portfolio was a 6X. Another one was a spin out of a company that we had invested in. And then the last one was a merger into a public company. So the numbers I mentioned before, we've had 110 shutdowns as of the end of last year, 82 exits, 54% still active. We don't count the tax benefits of the write-offs, which is a positive, but there's an offset of that is we assume that you make the best decisions as they go along because we don't know specifically when members exit. So if you hold on too long or you sell out too early, this is assuming you make the best exits along. So I think that's one of the reasons why our numbers are a little bit higher perhaps than some of the other ones that are out there. But we don't credit ourselves for the tax benefit of those write-offs. And actually that is a fairly significant part of the returns. As I said earlier, we tend to have about a half a dozen exits in a year. These are the companies over time. The biggest home runs we've had actually date back to 2013 before. We had one in 2013 and one in 2012. In 2020 so far, we've had 3 exits. Companion Medical was the one that's the biggest. It's 47X, and it's still, we have a stake in the outcome there that might actually push that over 100X eventually, because it was a company that was just spun out and we retained interest in. That was true for Zinalis, might actually be in that range because we were retaining part of that company. We've had in the last couple of years, finally had a couple of unicorns. Procore is a company that's the last round was at about a $4 billion valuation, and Appeal Sciences just this year crossed the $1 billion level. That was a company that Bill Gates was an early investor in as well. So we hope that those will become some successes in the future. We've had 3 really big exits over the years: Green Dot, Mindbody, and Sandpiper. And Green Dot was, if you sold at the peak as a public company, it would have been 235X. Mindbody would have been 263X. Since then, Mindbody's been taken private. Green Dot's still a public company, but trading less than that multiple. Sandpiper was a deal that was very early in Tech Coast Angels and had an exit early on. And then some of these other exits that have been lesser multiples. They're different, and Green Dot actually a lot of people invested in. It was probably, we put in $1.5 million or so into that deal. Mindbody was less. We had fewer people into it. We put probably a couple $100,000 in, and Sandpiper was also a deal that only a few investors went in. So, but anyway, this we count as a portfolio company if 2 or more investors put money in after the company is presented to Tech Coast Angels. That's the threshold to qualify for a return. One thing I'd like to say in terms of these home runs and the timing, we sometimes get an opportunity for an early exit. And in Green Dot, for instance, there was an opportunity to exit at 5X, and there was an opportunity to exit at 25X, and the IPO was at 100X. So sometimes taking that first offer on the table isn't necessarily the best deal. Mindbody also had an opportunity for an early exit. I think it was at 35X, and they obviously have done better in the long term. So one of the questions that members ask is when to expect outcomes. And one of the things that I don't like about the way those studies have been reported, where they say that it's 4.5 years to an outcome, it's very misleading, because in the early years, most of the outcomes are bad news. And it's not till the later years that the majority of the outcomes start to be good news. And so this looks at the shutdowns and exits by year. And you can see here that you get some outcomes in those early years, but in the first 5 years, particularly in the 3 to 5 year, you get companies running out of steam. They can't get raise the money because they just quite haven't met the milestones that they want. But after you get that past that valley of death, about 5 years, at least half of the companies we have outcomes. It's good news. And the magnitude of those tends to go up. So if you look at those outcomes by multiples, in the early years, the positives that come out tend to be modest outcomes. Those are companies that have some early traction. Somebody sees what they're doing, they come in and buy them out to grow them, but they tend not to pay outrageous amounts for them. And as you get into the later years, you get into companies that tend to be at a higher multiple. And if you look at in the highest area, in the 10 to 30 and the 30x kinds, we haven't seen any of those less than 5 years. And 2 of those 3 that we had that were in the 30x or more were in the 9 and 10 year range. And we just had one last year, a year before last, that was a 15x return. That was after 15 years. So there's a lesson to be patient and hang on. But one of the reasons we have turnover among our angel groups is that people make a few investments, they don't turn out well, and they give up. I think you really need to have a portfolio, and you ought to not give up too early. In terms of the timing of the cash realized, most of the returns on the portfolio happen, after 5 years, at least on our portfolio. That's been the pattern. And in fact, if you invested in all 200 of those companies that have had outcomes, it would have been almost 5 years into it where you crossed over even getting the money back that you'd put in. And you'd get up to about a 2 times return after about 5 years, and you wouldn't see those higher multiples till you got out into 10 years. So it's definitely a patience kind of a business. But there is some benefit of waiting them, because when we get those returns later on, they tend to be bigger. So it's not just, an IRR kind of a thing. So if you look on the left-hand side, the years held by multiple realized, if you look at the 1Xs, the average years held is 4.7, and 1 to 5X is about 4. As you look at the 5 to 10s and the 10s to 30 and up to the 30s, the years held outcomes tend to go up to realize those higher returns. And on the right chart, if you look at the payback, even though we're holding over a much longer period, the IRR on those deals has actually been higher. So the multiples, really, really do pay off. One of the things that's true of almost every portfolio I've seen is that a very small percentage of the deals make most of the cash return. So 2% of our deals represent 71% of the cash that's come out. And you could see another 4% is another 12%. So it's a very small sliver of deals that contribute the vast bulk of those returns. I remember I also am a member of the Harvard Business School Angels, and they had a conference about 4 years ago, and they had all these people from the different chapters around the world, and we had about 600 of us in the room at the time. And the keynote speaker was some super angel who had invested in 150 companies and had a few home runs of a couple 100x had come out of that, and he was come and give us a talk about, what were the keys to how he invested, and we were all anxiously waiting to hear what the key to all that was. And the first thing came out of his mouth is he said, I don't feel successful. And the reason I don't feel successful is, I invested in 150, and I had a couple of this. I had one at 150 and another one at 120 return, and I had 1 or 2 at 50 times return and a couple at 20. And but that's like, most of mine have been failures. And so in any one year, I may have 12 outcomes, but 11 of them are ones that are forgettable, and 1 I feel really good about. So about 11 months a year, I feel bad, and 1 month a year, I feel good. So I think that sort of summarized the deal we're in. You can't get you have to have thick skin for the failures, because they will come with even with the best investors out there. Diversification is key, and I'll show you a couple slides here that talk about the diversification from a quantified perspective. And the way I'm going to do that is do a Monte Carlo simulation of the portfolio. And I did this a few years ago when we had 160 outcomes. And So we did a Monte Carlo of that, and we did 20,000 potential outcomes. And as you can see on this chart, the left is the probability of some multiple of a return, and on the right is the multiple of that would be there. And as you can see, there's only a 26% likelihood that that 4.8x return would have been realized by somebody if they'd done 5 investments out of that portfolio. And if they moved that to a higher number of investments from 5 to 10 and 15 to 20, you can see those curves shift, and you can get a higher probability of being at or above that median return. But you still see that the outcome of the diversification, you have to go really high to be able to get to that outcome. So looking at that across all the portfolio, if you take the red line, which is that 4.8x, so you start out with 5 deals, you'd have a 25% chance of getting to there, and it would go up to 37%. If you say, what's my likelihood with 5 deals of getting 1x back? It's only 2/3 that you're going to get 1x back. And that goes up to practically 100% when you have enough diversification. And what's the likelihood of getting that 2.5 times, which is kind of the angel industry thing? It starts out at about 42% and goes up to 79%. So obviously it compresses. The more deals you have, you're not going to average 150 times return. But if you want to get those kind of industry averages, diversification is really, quite critical. I'm going to pause just there if there are any questions on that diversification before I go in and talk more of some of the lessons learned. Any questions on that?
Yeah, Mark had asked, and you may tell me if I'm paraphrasing this correctly or not, Mark. The question is to diversify or not. How confident are you that you can pick the winners if you don't diversify very much?
Well, it's my experience has been even the best angel investors, they may have a higher percentage of successes, and the best VCs, they may have a higher percentage of investments. But a good VC might have, instead of 1 in 10 success, they might have 2 in 10 success, but they still have 8 that are pretty forgettable. And I think the same's true of angel investments. I think it's true of stock investments, quite frankly. You can get very lucky. You've heard me tell the story, Dan, that I actually have had a better luck with my public investments. I've invested in about 60 public companies over the year and about 60 private companies. And I've had 5 of the public companies that I've gotten over 100x returns. One was a little software company up in your neck of the woods that I got an 1100x return. I invested in Apple, which was a 700x return. I invested in a couple others that were 300 or 400x. But if I said right now, if I'm investing am I going to pick the next Microsoft or Abbott Labs or Nucor or, I don't have confidence that I would do that. So even if you've been lucky in the past, doesn't necessarily mean you're going to be lucky in the future.
And one other related question, Magnus asked, and this is one many of us have asked, how do you collect your data? Do the companies report? Do you count on the angels to report? Is it complete, or are there things you're missing?
First of all, it is missing because we miss investments that individual angels make that don't report them to Tech Coast Angels. So I think we by definition, we understate the amount of investment we put in. And in terms of the outcomes, as I said, the methodology I've used is a very pragmatic. I try to have my ear to the ground. I monitor through Google searches, any press reports to see whether somebody's had an exit. And then if I'm aware of an exit, I then try to find out who invested, which we don't keep track of because everyone's very private at Tech Coast Angels. So I try to find out by word of mouth, who was invested in it. And I find somebody who's invested in it. And then I ask them, which round they were invested in and what decisions they made along the way. And what was the size of the check they got out relative to the size of the check that came in. And that's the way I work the multiple. I know when we made the investment because we do keep track of when we make investments. So I can do the IRR based on the timing. And so anyway, that's forensically how we do it. And then on a public company, I know what the value of the angel shares is at the date of the IPO, so I can calculate, how that fluctuates eventually as we get further out there. There are a few companies of the 80 or so that we've had has been positive outcomes. There are actually 3 that are not included in our data because I haven't been able to identify an individual that can answer those questions. So we don't include them. So for instance, TrueCar was one of the companies that we had invested in. That's a public company now. I'm sure that's a positive story, but I haven't found anybody to ask the question. So they're not in the data.
That's really helpful. So do you also count if a company comes through your group and some people invest and then afterwards they have the right to continue investing, but it never comes back through the group? Do you count those follow-on rounds as well?
Again, it's as reported. So we are asking all along whether those exist. And typically we get the data on the initial investments from the deal lead, who should be keeping track of that. I know the dozen or so deals that I've led, I keep a spreadsheet of that. So I monitor, who's expressed interest, and I ask them early on what the probability they might invest, so I can give some feedback to the entrepreneur of what the expected value might end up being. And I use that as an opportunity to ask all those potential investors what are the questions that they want to have addressed in due diligence. So I keep track of that spreadsheet. And so it's relatively easy for me to report that at the end because I know who's invested at the end, and I can give them that spreadsheet. But some others don't quite do that, but they may anecdotally do it. We use Procedure. So if everyone were religious about putting into Procedure the information on their investments, we could extract that. But my guess is about half of the people keep their Procedure listings up to date. So I find that that's really unreliable. And if you just rely on Procedure, you're going to definitely be understating it. I would love to have it as part of our member practices that everyone would commit to disclose that kind of information to TCA, because I think it would make a great deal of sense. And I also think it's kind of silly that we are protective of our privacy to the point where we never identify who is investing in what deals, because I think there's a lot we can learn from one another. It's not that we're going to hold the people who have a bad track record out and shame them, but I think the ones that have the good track record, we ought to bring them into our member education sessions and talk about what are the kinds of things that they're doing that are perhaps contributing to that. Like there's one investor in Orange County that as of a few years ago had invested in 15 deals, and 6 of those he had achieved 7-figure returns on. And so I was having conversations with him, and I asked what his key to was, and he says he focuses on the personality traits of the entrepreneur. I mean, we all talk about, the jockey and the jockey's track record and performance and so forth, but he actually uses the Myers-Briggs 4x4 matrix there. And he's determined there's one slice of 4 of those cells that he particularly looks for, and there's one cell within that that he thinks is the ideal spot. And when he's interviewing in the due diligence process, he doesn't actually make them take the test, but he asks enough questions that he feels that he can place them in that particular zone. And so I think it's good to hear those kinds of things, because I think it improves the outcomes. I'm spending a lot more time now trying to understand certain aspects of the entrepreneur, just because I've been burned by things. I think I'm a better investor now than I was 20 years ago. I think when I'm actually 160 years old, I actually know what I'm doing. But I think if we're learning from each other, we can accelerate that pattern and get to some good insights more quickly.
And I'll let you get on with the next few slides because I think they're important. But one last question from Joel. Just to confirm, these are all pre-tax kinds of calculations, and you don't take into account 1202 or anything else, correct?
No. So the tax benefits of 1202 or 1244, as I said, on the write-offs where you can put it as an ordinary loss, there's a higher tax benefit. and on the ones that you held for 5 years and you don't pay any tax. So these are all pre-tax. So there's some things that argue these things are higher or lower. In the interest of time, let me just go through some of these remaining things which talk about some of the lessons learned. As I said before, patience is important. If you look at the classes of years we made the investment, other than the companies we invested in 1997, we actually have active companies in the portfolio for every single year. So these things can take forever to be resolved. And obviously in the most recent 4 or 5 years, there's not much in terms of a resolution. In terms of the industries producing exits, we've had the most outcomes in consumer internet, software, and life sciences. You can see we've had a lot of active companies in each of these industries. But if you look at the green and red ones, which is the failures and the exits, we've had a share of them in all of them. Our multiples have been highest in financial and software, but that's largely driven by MindBody and Green Dot being in those verticals. We do pretty poorly in the consumer internet area and consumer products. We do tend to do well, I think, generally in software because a lot of this enterprise software and the outcomes tend to be more than $100 million outcomes, as in life sciences, those outcomes tend to be a little bit bigger. So there's some reasons. This starts to raise questions of why we are seeing that. And I can certainly hypothesize some things based on my own experience. A lot of the consumer businesses, you just don't get those high multiples because even if you get a successful consumer product business and you get to a successful outcome, you're going to sell it probably for $10 to $20 million. You just don't sell those businesses for $100 million or $1 billion. Occasionally you'll get a Nest software that might go for more than that, or Nest, thermostats. But most of those consumer-oriented businesses tend to have pretty modest outcomes, and so you don't get to those high multiples in those kinds of businesses. Most of the money coming back have been in financial and software. Again, that's been driven largely by our home runs. The width of these bars is the number of companies that we've had outcomes on, positive and negative, and the height of the bar is the average multiple. So the area is kind of where the dollars have come out. As you mentioned before, most of your investment is in the Pacific Northwest. Most of ours has been in Southern California. In the area where we've done more syndication, the amount outside Southern California has increased. It's now up to probably 35, even 40% of the deals are outside. And I think that's reflective of the amount of syndication that we're doing. So far, our returns actually have been higher of the ones that are within Southern California. I think over time, those numbers are going to start converging. There's certainly something to be said that the value of a group like ours and like A of A does is in the value of the mentoring and guidance. And sometimes when we invest remotely and we're not paying attention to it, we're not going to have that same kind of outcomes. But most of the deals we're doing outside, there is some group that's like ourselves that's providing that guidance. So I don't think that's going to be that differentiated. A couple of the things from the data that have been just mentioned in passing, some of the Wilt Bank studies have looked at what's the benefit from doing due diligence. And this was a chart that showed that where a significant amount of due diligence is done, it's much more likely to contribute to being a higher multiple. If you look at those higher multiples on the right, and if you look at just the average where less than 20 hours of due diligence is done, the average multiple's been 1.1x. Where over 20 hours, the average is 5.9x. And when it's over 40, it's 7.1x. I would say from my own experience is there is a relationship there, but it's not necessarily the number of hours. It's the level of expertise. And I'll show you this chart here that where the angel group brought people to bear that had areas of expertise to apply have had higher returns. I found that when you can tap on members that have the expertise, you not only do a better job of due diligence, you give better coaching to the company, you give better mentoring to the company in terms of opening up doors for them, but you also do the diligence a lot less time. because you're not spending a lot of time. Obviously, if you don't know anything about a particular deal, most of the deals you see look great until you have somebody who understands it. I'll give you one quick anecdote. There was one company years back that was a very articulate young woman, came out of a big chemicals background, that was making a synthetic artificial fragrance that was comparable to citronella, and it was a lot less expensive. And so a lot of people wanted to use citronella, but they weren't because of the cost. And so it all sounded great, but we're looking around her room in the screening saying, what do we know about fragrances? And one of the new members raised his hand in the back. He says, I have a few questions, and I've just joined last month, but before I joined, I spent 25 years at International Flavors of Fragrances. I was the general counsel. So we immediately said, okay, what questions do you have, Steve? And he asked the questions, and he led the due diligence. He got on the board, and we went through 3 or 4 stages of VC investment, and we had a positive outcome. But we never developed a fragrance practice. But when you can bring to bear that expertise, it's true. One of the other observations is companies that get follow-ons have a higher probability of having a positive IRR than the ones that don't. Now, this is just data from Central Texas Angel Network. On the left are the exits, and the right are their shutdowns. They clearly have shutdowns in both categories, but you can see a higher percentage of the ones with the exits are the ones with a follow-on, and the IRR of those exits has been 54% for the ones that had the follow-ons, and 11% for the ones that didn't. So usually it's showing that the company is making enough progress that people are willing to put more money in. That means certain things have been de-risked, and even though the valuations may be a little bit higher, a higher percentage of those will get to an outcome, and so that it tends to produce higher IRRs. Another thing that the data is often, we look for people with experience. This is data that Central Texas Angel Network had from their data that says that where they have serial entrepreneur, a much higher percentage of them have had exits or still active in their portfolio. And if they look at it from just a perspective of a first-time CEO, again, they have a higher percentage of those having the resiliency to be able to get to an exit and an actives. But I point out that this is so much a numbers game that you'd really make a mistake if you said, I'm not going to see any companies that don't have a CEO with prior experience. Because if you look at the 5 companies that have created the most market value, you'd be turning yourself off to a lot of good people. So Steve Jobs, Bill Gates, Jeff Bezos, Sergey Brin, Larry Page, Mark Zuckerberg, all were first-time CEOs, and they've all done pretty well. So if you say, I'm never going to see those kinds of companies, you'll probably get disappointed. So it's one of the factors. All the other things being equal, it certainly benefits having somebody who's been to the movie before, but it's not the only thing. And I'll just make as one other footnote. The CEO of Green Dot had no previous experience. So even in our own portfolio, if we had ruled those out, our performance would be much less. And then one final comment on terms of lessons learned is, at least in our portfolio, avoid the temptation of early exits. I can give you some war stories of times when I failed to take my money off the table and ended up seeing nothing for it. But if you took all of those and the ones that had multiples and went on to big home runs, so if you always left your money in versus always taking it off the table at the first exit, you would have seen that overall return drop from 4.8 to 2.4. And the IRR would also have dropped to 21% from 26%. So, look at those things holistically. I have a couple stories on mine where I had one that went public at a 5x, and we had a 6-month lockout, and by then it was 2x. I held on, eventually became a 0x. So the way we would count it in our scoring, we would have counted as 2x, but I didn't see the 2x, but also nobody saw the 5x, so we don't count that sort of thing. So the last page of our report had some lessons that we kind of passed along to our entrepreneurs in our system. And it is a good time to make investments. The valuations, as I said, I think are going down now. And we did a survey on that, which I showed earlier, that our expectations of valuations are expected to go down by our members considerably in the coming year and a half. And there will be some opportunities. And some of the companies that do get funding in this trying time will have fewer competitors and will do very well. And a lot of them will go on to great things. But it's not a time for the faint of heart. So I'll end it there and turn over if there are any other questions that anyone would like to pose.
If anybody will hang on for another 10 minutes or so, if anybody has questions, feel free to unmute yourself and ask them.
Okay.
John, one question from me, because sort of we're trying to think about how to do this ourselves. How much work did it take to get the data together?
So there's stages of that. My guess is that you probably collectively, among a group of people who have been at this for a while, if you probably know the companies that are in the portfolio, right? Because you put that on your website and so forth. And you probably, from word of mouth, have an idea of which ones you've had positive exits and which ones have gone out of business. So the first step is you need to do that bucketing. So I started with that tribal knowledge, and then I supplemented that by going and finding all the companies and seeing if where they had current websites, and I added to some fatalities because I couldn't find the companies anymore. So that was step one, in the buckets. You obviously don't need to do anything forensically for the ones that were total write-offs. That's easy. But for the ones that there was, you just need to find somebody was in it. So depending on whether you keep track of who was in the deals and how hard it is to find it, there's that part of the process. But once you find individuals that have been involved in the deal, and I often get multiples because they've invested at different times, it's just a matter of some email interactions back and forth and just asking them to look up what they invested and look up what they did, and I can get that. And then putting it together in a spreadsheet and starting to do the other analysis is kind of the easy part after that. And then keeping it up to date every year isn't a monumental task. But it probably, once I got to the point where I'd done this once, doing that and generating all these charts and updating every year, it's probably takes me a week's worth of work to do. To do the updates.
Do you try to calculate how much money went in from the entire group to each deal, or do you just assume that it's a flat amount?
That's one of the functions that thankfully I don't have to do. That's one that our paid director does. So that's one of the things in his job description. They're supposed to do that. And we have one person who does that for all of Tech Coast Angels. And so we pay for all that out of the collective Tech Coast Angel bucket to monitor that. And he has, and then the directors, and he's responsible for one of the networks. And so he knows what deals have closed and who were the deal leads and those kinds of things. And then we keep track, we talk a lot about what deals we've closed and what deals were about to be closed. So there's a conversation about that on an ongoing basis. And then when he finds out who the deal leads are, and we do try to keep track of that because otherwise we wouldn't know who to ask, he then follows up with the deal leads, and there's a simple Google Docs collection form which collects that information. And we also try to collect on that the information that we need to report ultimately in the ACA database, so that when he fills that form out, he's trying to collect the information that way. One of the things forensically that I'm in the process of doing now is I'm going back with those companies, the 200 that we've had the outcomes on, and I'm going back to certain sources of information to be able to collect information that I can do more robust analysis on the outcomes. So for instance, I'm going through the procedure and trying to find the original term sheets so I can start to categorize the deal terms, the valuations, and the deal terms. I'm going to trying to find the LinkedIn profiles of the entrepreneur, so I can ask a bunch of questions about, what was their previous experience and those kinds of things. So we get some stuff from that. And to the extent that I aware of other information that might be able to get access to. I'll be going back to the Procedure listing itself and see if there's any other kind of nuggets in there. And so we're building additional stuff. And then when we do that and we find that certain things are having a pattern, we're going to bring that forward at ACA and ask the other angel groups to add those kinds of pieces of data to see whether we can confirm that on a broader basis. So this will only get better as we all share our learnings and add more things to it. And most likely there'll be some things that we thought were really mattered that don't matter, and there's some things that didn't really matter. And I think as we start to factor that in, again, holistically, don't pick any one of them as there's going to be aberrations on all of those things. But I think that will improve the quality of games. The third thing, by the way, I'm doing forensically is I'm trying to get a copy of the original presentation that was made. And then for the ones that are top 10 big successes, we're gonna have a little focus group where we all look at it and say, well, what happened? How many of them actually pivoted from what we originally presented, and tell stories around that, and start to do more of a case study around that. So I guess that's the third thing that we're gonna do. And some of these did have big pivots. The MindBody, or the Green Dot, the original company that we funded and raised $1.5 million for them on, was actually a pretty stupid idea, which was this was back in 2003 or 4, long time ago, 2003. They were going to create a prepaid debit card for rich teenagers because they couldn't have a credit rating and couldn't get a credit card. And so they built this whole infrastructure to do that. And 6 months into that, they realized that the rich teenagers just used mom or dad's credit card, didn't have a problem. But there was this big group of the population that was underbanked that couldn't get a credit card. So they pivoted it to go use the same infrastructure to go to the underbanked. And that's what they built the company on. And, they built it out and got in Walmart and all these great distribution channels. And they got to the endpoint. But the other thing from that case story is, even though that turns out to have been a good category to have invested in, at the time they invested, there were, I think, 16 other companies doing the same thing. And that particular entrepreneur, even though he had no base background as a CEO, he was very resilient. They had a couple near-death experiences, but at the end of the race, 15 of those 16 went out of business, and he was the one who won. So even if we thought that was a great thing to invest in, we could have picked one of the other 14. So it's a hazardous journey that we all go on, but we'll try to get more of those case studies coming out of this, and I think that will, elevate everybody's game to do more learning from that.
Well, I think this.
And obviously, we're going to look at some of this.
This could go on for another 3 hours. I know I always enjoy talking with you, but on behalf of everybody at the Alliance of Angels who participated today, thank you very much, both for your time today and for your leadership in this topic that is one that has bedeviled angels for many years. And it's nice to see some really concrete and good information on it that we can all understand and share. So
thank you for the opportunity.
Thank you.
If anyone has any follow-up questions, just reach out to me, and Dan can forward my email if anyone has further questions.
So thanks again, and everybody on the call, have a great rest of your day.
Okay, stay safe, and hopefully the fires burn themselves out and we all get to breathe a little bit better.
Yeah, can I inject one last question, please? You mentioned some sort of test to evaluate the quality of the entrepreneur. Can you repeat the name of that test, please?
Oh, it's called Myers-Briggs.
Myers-Briggs. Okay, thank you.
And it's something that companies often do in team building, because there are it's like looking at the range of introvert to extrovert, those kinds of ranges. There are 4 of those dimensions, and then you take the two modes for each of those, and it's a 4x4 matrix. So you have those, and in a team building, you know, typically a team gets spread around that matrix, and there's no typically optimal place to be for a team. You want people with different places on there, but actually for the characteristics of a startup CEO, there are certain characteristics that tend to relate to this resilience and improvisational and action-oriented stuff that tends to relate to one cell versus the other. But that's the term. And if you follow up, I can tell you more about which of the cells he likes.
Sounds like
No,
a
I'm
future
definitely
topic
gonna look into
for a
that one.
seminar.
Yeah. Okay.
Well, thanks again. Thanks for being so generous with your time, John.
Thank you very much.
Okay. My pleasure. Okay. Be safe. Bye.